Hello, friends. Welcome back to Harvesting Income. This is the place where you learn how to make your income and grow your income from income oriented investing methods. We have two um, ETFs from iShares. Some of you might be familiar with IVV, which is on the top left. It is the iShares Core S&P 500 ETF. And the other one we have is IVVW, again from iShares, but this is the S&P 500 Buy-Write ETF. Okay, for those who are not familiar, IVV is basically S&P 500 index-oriented exchange-traded fund, which means that this fund, exactly replicates the S&P 500 index and invests in the 500 stocks or constituents of the index. Basically, it mirrors the index or replicates the index. That's IVV for you. Now, moving on to the second one, IVVW. This is actually a fund that holds IVV. IVVW actually holds the other fund, which is the core S&P 500, and using that, they write covered calls on top of it. The reason for writing covered calls is to generate income on top of the current index ETF that they have in their holdings. So IVVW actually is a fund of fund, it holds the first fund and writes covered calls. That's the whole concept. Now we are going to compare these two funds to understand if it's a good idea to invest in the index or is it a good idea to invest in the index with the covered calls, and we'll know what are the different pros and cons of each. I hope you'll enjoy this. Okay, with that, let's get straight into the comparison, just to get a background of both funds. IVV is a longer fund with a lot of history. They were started in back in May 2020, like more than 6 years now, and IVV was started March 2024. IVV, which is the the S&P 500 core fund, it has about 842 billion in assets, and the BuyWrite fund has about 304 million. Obviously, because it's a covered call fund and it's newer fund, it has a lower assets. And iShares or BlackRock, the fund house, basically is known for to be one of the top asset managers in terms of the index ETFs, mutual funds, and various other products that they have, like for an entire suite of investors ranging from retail to institutional investors. So that's the basic background that we have about these two funds. And let's look at the fees or the expense ratio that they charge. If you look at IVV, since it is a index fund or index ETF, they have a management fee and expense ratio of 3 basis points, 0.03. Because it directly tracks the index, there's not much of a management, not much of involvement by the fund manager in terms of picking stocks or sectors or research. Basically, they have to maintain the in balance as per the index and follow the guidelines or the constituents of the index. So that's precisely what they do. And when you come to the BuyWrite ETF on the right side, you have about 22 basis points management fee. Why it is so high? Because you have fund managers picking up certain strike prices and writing calls on the fund. So every month the fund managers have to write calls and generate income for the fund. So that's why the fund management fees higher at 22 basis points. And when you look at the management expense ratio, it is 20.25% or 25 basis points, because um, it involves both. It adds up both the management fee plus the zero point zero 0.03 expense ratio of the IVV, because IVVW actually holds IVV. So because of that, that extra 3 basis points gets added to the fee. So totally it becomes 25 basis points, which is the fee for IVVW. Again, I mentioned, like, the reason for the high fee is because the fund managers are spending time and effort writing calls to generate that extra income. So that explains the fee part of it. Now let's move into understanding, like, what the other aspects, like the returns and also the portfolio. Portfolio composition is very simple. It's the S&P 500. Now I'm going to talk about the returns. That's what everybody is keen to hear about, the returns or distribution or yield. Uh, so the IVV is actually quarterly, distribution payment in terms of the frequency, and BuyWrite fund, right, it gives monthly dividend payouts. So that's the difference, and the reason for the monthly or higher frequency is because the fund writes monthly covered calls and generates regular income. So that income has to be distributed to the unit holders. So that explains why it is monthly for the BuyWrite fund. And in terms of distribution yield, you see that IVV is 1.1%, just like any other index fund. And for the BuyWrite one, IVVW, it's 19.9%. Like they are almost generating about more than 1.5% a month on an average, roughly. So that's why you see the higher number. But this is just one part of the story, one half of the story. When you see the other half in terms of the price appreciation or return, you'll get the full picture. And we'll also look at the total return to get a more holistic view. Okay, in terms of the price return, IVV actually wins. They have 20.9%, whereas IVVW, which is the BuyWrite fund, actually is losing money because they lost 3.8%. I'm looking at the 1 year performance. So this is not everything. This is just the 1 year performance. And for the purpose of this video, I'm just, restricting to 1 year. But if you can go to any website like Seeking Alpha or Google Finance, you can get data for last 3 years or 5 years. Let me go to the total returns to give you the whole picture so that you can see the big picture and see what you're getting in either case. Uh, okay, I have put IVV and IVVW, side by side so you can compare. In terms of price return, obviously IVV is the winner, like they have 20.9%. And in terms of the yield, IVVW is the winner. Like let me go one by one. In terms of price return, IVV generates about 20.9%, whereas IVVW lost close to 4%, like 3.8% to be precise. And in terms of the distribution yield, IVV generates 1.1%, whereas the BuyWrite fund generates 19.9%. So when you add up these together, like total return for IVV 22.1%, and for the BuyWrite fund it is 16.1%. So there's a clear 5 percentage point advantage if you invest in the index directly. So that's why some people in the industry or experts, they say that investing in the index helps you beat most of the funds, at least 90-95% of the funds. And this explains why. However, there is a case or a use case or an application for covered call funds as well. There are times when the markets are pretty flat, pretty gloomy, or bearish markets or flat markets or choppy markets. In those conditions, the covered calls help you generate that regular income, and that income is captured in terms of the premiums that the fund collects by writing calls. At the same time, when they write calls, you're also able to reduce the volatility. So that's the part we'll discuss in the later slide. But that's the essence of using covered calls. Even though you're getting lesser returns, you're getting regular income, which helps you maintain the you know desire for lesser volatility and regular cash flows in terms of volatile markets where there is a lot of uncertainty. Now, when I compared this with the benchmark, like 16% and benchmark is 22%, the return capture ratio, this is just my own term that I've used. So basically 16.1 divided by 22.1. If I do the capture, like it should be at least 60% in my own, sense of, assessing the performance of the covered call fund. So it's 73%, which for me is pretty good. I would expect something anything higher than 60% is decent. Below 60%, 50 to 60%, for example, you need to look at the closely at what is happening. Uh, so since it is above 70%, like I'm not too worried. It's pretty positive, pretty good. So that's the total return for you. So depending on your style of investing, you can choose whichever fund you like. But let me look into the mechanics. Next slide will be about that. What are the different strategy? What is the portfolio and all that? Now, in terms of IVV, it's pretty clear. I will go column by column now. So when you look at IVV, the portfolio is basically the S&P 500 stocks and whatever is in the S&P 500. And the structure is basically directly the fund owns the stocks. The fund buys the stocks and maintains the same formula or the proportions or calculations as per the S&P 500 index. And the strategy is pretty straightforward. It is passive index tracking. So there's no special trading strategy or any research done by the fund manager. They just maintain the fund uh, to follow the S&P 500 index. That's all. It's very simple. Now, when I look at the IVVW, the portfolio is not the individual stocks. IVVW holds the IVV ETF. So rather than holding the individual stocks, it holds the ETF wrapper, which ultimately contains the stocks. But instead of holding 500 different stocks, they're easily able to replicate the same performance with IVV ETF. So it's much easier or much more efficient, cost effective. You can use different words for that. Ultimately, it's about efficiency and cost effectiveness and lesser amount of efforts involved. So that's why they hold the IVV ETF directly. And IVV ETF has already done the work of you know capturing the whole S&P 500 stocks and maintaining that. Now the second part is because it's a fund of fund structure, like it owns the other fund. So the structure is that the fund is not owning the stocks, but instead the fund is owning the other fund. So that's why it's a difference, and you see the difference in the fees also, right? The fee is a little bit higher. Uh, and then you have the investing strategy which involves owning the IVV ETF and writing calls. So when they write calls, they write calls which are 1% above the market level. So 1% above means 1% out of the money. So when the fund writes calls which are above the current market level, they are able to capture that upside 1% above the market level. But if the market rallies very fast and moves like 3% or 4%, then the fund is only able to capture 1%. So the fund is capped to that extent. So it can be a positive, it can be a negative, depending on how the markets perform and how the fund is able to capture that upside. So that summarizes your portfolio and the structure and the investment strategy of the fund. Now, as we move ahead, like I wanted to just quickly show you this part. This is pretty simple. The fund writes calls on the entire portfolio, roughly entire portfolio, but they keep a very small portion for any, what do you call redemptions or any operational expenses. So that's why, this fund is actually 99.8% covered, like almost 100% covered. And they write 1% out of the money, as I said, and this 1% out of the money is every month. So every month they reset the calls. So this month they may write at the current market level plus 1%. Next month the market trades at a different level. So they will write calls at that different level plus 1% and write the calls accordingly. So every month it keeps on changing. So it's pretty variable. And yeah, that's how the fund works. So they're able to capture that upside to some extent because of the out of the money calls. Even though the fund is fully covered, they still have the room for upside. Okay, so now we have the strategy, we have the all the information in front of us. Now I'm just putting all the points quickly to summarize everything for you. So we have already discussed about the funds holdings. S&P 500 stocks are held by the IVV. BuyWrite fund holds the IVV ETF, and investing strategies index replication versus uh, IVV plus covered call writing on the BuyWrite side. Return source, yeah, this is the most important part. Like it's a little tricky, but IVV is pretty straightforward because you have the index appreciation and the index stocks dividends. So those are the two sources of income or return for the investor or for the fund, you can say, and then the fund distributes, profits to the investor. Now, when you look at the IVVW, the Buy-Write fund, they have a slightly different model because they invest in the IVV fund. So whatever IVV fund, you know, um, achieves in terms of appreciation, NAV appreciation, net asset value appreciation, the Buy-Write fund is going to get benefit from that. That's point number one. And point number two, when the IVV fund distributes any distributions to their investor, IVVW is also having a portion of it. So they will get that share too. So that's the first part you need to understand. The second part is um, the fund manager of the BuyWrite fund actually writes covered calls. So when the fund manager writes covered calls, they're going to collect those premiums, So the premium income coming from those calls is going to add another layer of income. That's an extra layer of income. In fact, that is a major layer of income for this fund. And finally, if the underlying fund, let's say IVV, starts appreciating, like they appreciate more than 1% or something, for example, so the fund will achieve that appreciation. And when the appreciation is about 1% or higher, the strike price of the calls will get triggered, or they would get assigned. So if you are someone who is writing covered calls, you may be familiar with call assignment or call exercise. So this happens when, let's say, IVV is at a certain market level and the covered call is written 1% above that. But let's say the market moves more than 1%. So in that case, the strike price at 1% higher level will get triggered, and that profit is going to get booked. So that means that they will get that capital gain or appreciation on the IVV that they hold in their portfolio, which got sold off at a higher price. So that's the simple way of explaining it. So they are getting the capital gain from the sale of IVV. Expense ratio, obviously, IVV beats the buy-write fund, and buy-write fund is expensive because of the covered calls and the income and all that. And fund management, this one is passive. IVV is passive. The other one is more moderately active, like because they hold the IVV passively, but they write covered calls actively. So it's moderately active. And the uh, the good thing is that they are actually able to reduce the amount of activity compared to other index covered call funds like JP and all that, because IVVW holds their own in-house index fund. So they don't have to maintain all those 500 stocks and do all the hard work, because their in-house fund is already doing the hard work for them. It's already ready-made, done for them. So that way they're able to efficiently utilize or leverage their own asset to maintain the holdings. And writing covered calls obviously is an active strategy. The drawback that you would see is that in case of the first one, the index fund, you will have lower income and lower activity. That's obvious. I don't see that as a major drawback. Any index ETF will have a lower income, but it also has a lower amount of activity, so you cannot do much. Like you just have to buy and hold. But in the case of IVVW, yes, there is a problem with the strike prices when the calls are written, and the upside is capped at that level. And when the index is declining, let's say in a very bearish market, so then that can drag down the price of the fund, because obviously the declining index is going to drag the NAV. Even though the premium is coming in, the decline in the market will be much higher than what you earn in premiums. The premium income is not going to fully compensate for the decline in the market. Market declines by 10%. Probably premium income will give you that 1% cushion to compensate for that loss, but it's not going to make a huge compensation when the market declines significantly. So that's the message you need to understand in terms of the drawback. But for a long-term income-oriented investor, this is something they should be able to stomach it. Again, this is not investment advice, but for a long-term income-oriented investor, this is something that you can, tolerate or you can manage over a period of time. Okay. The final point is coming to the suitability, which we already mentioned in, bits and pieces here and there. IVV obviously is a very passive oriented fund. It follows the index. So a passive investor or a couch potato portfolio uh, would actually have more of IVV. A passive investor would like to go with IVV because they can set it and forget it, keep it for the long term. They don't have to manage anything. They don't have to worry about the ups and downs, because ultimately the market is going to recover. And over a period of time, like 10 years and so, uh, there is an expectation that the returns will be more or less positive, and you can build a lot of wealth over a period of time. However, when you come to the other side, This investor is moderately passive, and since he's seeking a covered call fund, he's actually seeking some income on a regular basis. And this kind of investor is also worried about the volatility or ups and downs in the market and needs some income to maintain that, you know, income level or cash flow levels, so that even if the markets are down, they are not worried about selling the fund, or they're not worried about changing the portfolio and so on. So they would like to get that regular flow of income to manage or to compensate for that volatility that they are having in the portfolio. So that summarizes the comparison between IVV and the IVVW. I hope you like this video, and if you have any comments or any suggestions, please drop them below. Have a nice day. Happy investing.